I'm Owen Bigland. This is the Inside Edge video blog. I'm going to cover a number of topics with this blog. Everything from consumer debt levels, credit card interest rates, mortgage stress test, current situation with the mortgage rates right now, and touch a little bit on the TFSAs and saving for retirement here. So I'm going to go on a little bit of a rant here, a little bit of a complaint. It's been a while since I've done one of these, but here we go. My wife and I were having dinner a couple weeks ago, and she was opening her mail and opened a letter from TD Bank with her TD Visa card and slid it across the table to me and said, the letter basically stated that effective February 1st, your TD Visa rate, interest rate, is going from 19.99% to 24.99%, so 25%. And I got a little bit of a chuckle out of that because I've blogged on this many times over the years how, credit card debt is loan sharking. As a matter of fact, I think you could go down to the local pool hall here and probably get secure a better interest rate than what TD and Royal Bank are giving you on their credit cards right now. Now, I should point out that both my wife and I have owned Visa cards, had held Visa cards for many decades. We've never paid a red cent to TD Bank or Royal Bank for interest charges, and hopefully you haven't either. You're out of your mind if you do, if you're keeping any type of a balance on your credit card. But the point I want to make here are a couple of things. First off, of course, in the last, I don't think my rate, maybe some people can comment on here, I know on my Visa card with Royal Bank, my interest rate is at 19.99%. I don't think that's budged for as long as I can remember, at least 10 years now. But of course, in the last decade, interest rates have been on a slow and steady descent. We're headed to zero eventually, like they are in Europe here. But, the prime lending rate is below 2% now. Yet, of course, credit cards have stayed at 20%, or this is the crazy thing and why you want to own Canadian banks. They're actually raising interest rates now to 25%. And some people have told me that there's some of these specialty cards out there, grocery store and department store credit cards, that I think are hovering close to 30%, which is absolutely crazy. You never want to be keeping a balance on these things. This is beyond loan sharking. And it's the other reason why I tell people just to own the Canadian banks and hang on to them. It's a license to print money. Something like 35 or 40% of Canadians, and same thing down in the States, hold balances on their credit cards at these ridiculously, obscenely high interest rate levels. But here's the point I want to make, and if you've been following me on Twitter, there's been a lot more talk here about the mortgage stress test, and is it working? Who exactly is the government trying to protect here with this mortgage stress test? And the other thing which I pointed out before too, it makes no sense to me at all why the government is obsessed with preventing young people, basically trying to save them from themselves, with this 2% stress test and keeping them out of the housing market, when taking on a mortgage and buying a home is what's considered by every financial expert as good debt. First off, you're buying a tangible asset, you're buying a roof over your house, which is a necessity. You need a place to live. The second thing is you're buying an appreciating asset. The home will appreciate over time. It's not going to go up every year. As I've pointed out many times in the last 10 years here, real estate has good years and bad years. But I can tell you, if you were to buy a one-bedroom Yaletown condo today, in 8 years, 10 years, it will be worth far more than what you paid for it. In the short term, 1 or 2 years, who knows, but who cares? You need a roof over your head. In 25 years or less, when that mortgage is paid off, it'll probably be worth 2 to 3 times what you paid for it. That's a fact, and I'm using conservative numbers there. But we've got a government policy here that is absolutely obsessed with preventing people from taking on good debt at 2.6% interest rates. 2.6%, you can lock in a 3-year mortgage rate now. You can lock in a 5-year mortgage rate now at like 2.85. You're buying an appreciating asset, you're taking advantage of leverage, you're buying a principal residence that's basically the only true tax shelter we get. All the capital gain will flow to you tax-free. It is far and away the best single investment a person can make, a young person can. Buy it, hold it, you will do incredible on it. And again, you need a roof over your head. The alternative, of course, is to get into what I call that renter treadmill. There is no alternative to buying your home, not in a city like Vancouver or Toronto or any other expensive city, where you're paying $2,100, $2,200, $2,300 a month for your rent payment. You're making landlords like me wealthy. Once you get in, the biggest hurdle is saving for the down payment. At 2.6% interest rates, once you've bought, your cost to hold that home isn't much more than what it's costing you to rent, and you're getting back zero in rent, of course. Typical person in their mid-20s right now, do the math. You're going to spend well over $1 million over the next 25 or 30 years on rent. Easily over $1 million with nothing to show for it. So it never ceases to amaze me why the government is infatuated with this stress test, and now many pundits are coming out now saying it's not working, and why are you preventing young people from getting in the housing market and getting into good debt at 2.6%? Yet the credit card industry at 25% interest rates goes completely unchecked. Nobody even talks about these raises at 20 and 25% credit card rates. It doesn't make any sense to me. And of course, on credit cards, you're buying groceries, you're buying furniture, running shoes, car payments, whatever else. Those aren't appreciating assets. Those are depreciating assets, or you're just consuming them like groceries. Yet the house is an appreciating asset. You're taking advantage of leverage. It's tax-free growth, and it's providing you with shelter. It's a necessity. Maybe hear your comments on it, but this is again why I tell everyone to own Royal Bank and own TD Bank and own all the major banks when they're doling out interest rates, and apparently 35 or 40% of Canadians hold balances on these credit cards. It's loan sharking. And that's why they continue to raise their dividends every single year on these banks, and they're yielding me now over 5%. Own the Canadian banks. But a lot more articles I've been posting on my Twitter feed questioning this stress test. The Bank of Canada and the federal government, they need to understand something. You're never going to save people from themselves. There's always going to be some outliers that take on too much debt, aren't responsible with credit, over-leverage themselves. But I think they're throwing the baby out with the bathwater. They are outliers, maybe 5% at most, and they're always going to be there. But you're preventing the other 95% from getting in on the single best investment they can make, getting into their principal residence. As I've often said, buying your principal residence at a young age is a huge hurdle in life. You've crossed a massive financial hurdle, and it's pretty smooth sailing once you've got in. The hard part, though, is saving for the down payment. And do not keep credit card debt. Anyone that's saving for retirement or saving for a home and has even a penny in credit card balance needs to clear that off first before you start anything. No money into the RSP, TFSA, nothing. Not when you're paying 20 or 25% on a credit card balance. The other thing I'll point out too, just the ridiculousness of this stress test really, is the fact that how difficult it is to get a mortgage anyways. Again, they're trying to save people from themselves. As I did a blog last month, foreclosures in this country are less than a fraction of 1%. And as I've also pointed out there, foreclosures are generally a result of a life-changing moment in time. You either lose your job, you get laid off, lose your job, you become disabled and can't work, a divorce, a lawsuit, something triggers falling behind on your mortgage payments, and that's life. You're never going to protect someone from these life-changing occurrences. They happen. It sucks, but these things happen for people. That's what triggers most people getting into trouble on their mortgage payments. If anyone, if I'm pointed out too, is anyone that's ever tried to get a mortgage in Canada over the last 10 years, even before the stress test, I don't even think it's possible to over leverage or take on too much debt. I think it's virtually impossible when it comes to buying a home. I don't think it's possible. All you have to do, anyone that says it is, has never applied for a mortgage in Canada. And I'm talking before the 2% stress test. You had to give 2 to 3 years worth of T4 slips, prove your income, show your deposit funds. The 5% down is gone, it'll never be back. The majority of buyers now are doing conventional mortgages, 20% down or more. I've even noticed several years ago, even on buying investment properties, you always needed a conventional mortgage there. But more and more of my investors now, the banks are requiring 25% down. So there is very little risk there. That is not over leveraging when you're putting 15, 20, 25% down and borrowing at 2.6%. Pretty much impossible for someone to over leverage themselves or get into too much debt on buying a home. Yet the government is doing everything they can to try and limit your ability to buy a home and keep you in that renter treadmill. Yet they don't do anything about the credit card debts at or credit card rates at 20 and 25%. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.